Hello and welcome. I'm Financial Standard Editor Mark Smith, and today I'm joined by Philippe Jourdan, President of CFM International, and we're here to talk about the group's alternative beta strategy. Hi Philippe, thanks for joining us.
Thanks for having me.
Well Philippe, what's the problem you're trying to solve for investors?
Well, we're coming from a very particular angle. We're a quant firm. We've been in business for 25 years. We run a large multi-strategy business in quant, and we've come to the conclusion that there are a number of persistent models that share the persistence quality with things that we call beta. So we're all anchored in our portfolios to what we call beta, which is exposure to the growth factor. So we have these indexes that are built on a market cap weighted basis that are investing in companies that are extracting growth and delivering that growth back in the form of either dividends or appreciation of the stock. This growth factor has been very persistent over centuries. Intuitively, people have developed a familiarity with that growth factor that says the following: if I'm long the market long enough, I'll be okay and I'll make a decent return out of it. And we've all bought into this culturally, and I think it's a good thing. This, historically, has been run on a combination with sovereign fixed income as a diversifier. That diversifier no longer functions. In the post-QE world, nobody's getting significant rates of return out of their sovereign fixed income portfolios or any significant duration. So a lot of portfolios today are concentrated in this growth factor. And we believe, actually we know, that there are a number of other factors that share the same quality that we like in the growth factor, which is persistence. Right? What do we like about the stock market on a beta basis is that we know that it's a persistent phenomenon over time. We believe and know that this is also true of long-term trend following on a multi-asset class basis. This is also true of value investing in an equity market neutral format. This is true of single name stock residual momentum. Perhaps I can explain at a later date what that is. It's a bit complicated, but it's basically trend following on a single name stock without the beta, without all the other style factors. Quality factors in estimating the disclosures of companies. And then what we call risk premias, which are really reinsurance businesses. There's a whole series of factors in the market whereby you get rewarded for offering reinsurance services to other market participants that want to get rid of risk. Now, what's interesting is that these individual factors, while they share persistence with the growth factor and have similar Sharpe ratios, about 0.4, are very different in when they actually work, which means their correlations are low. And if you have a sufficient amount of factors that have low correlations to one another, you can achieve what's called portfolio effect, which is the only true free lunch in finance. And your aggregate Sharpe ratio can go up from 0.4 to 0.8. And that's what we're proposing. That's the conversation that we would like to engage the market with.
And what are some of the shortcomings of other strategies on the market?
In this particular region, I think the appetite for alternative beta is very strong for all kinds of reasons. I think it's true everywhere in the world, but in this region, there's a big emphasis on fees. And fees, if you are sufficiently dogmatic about it, will shape outcomes. And there are a number of what I would call fixed income replacement products that might not stand on their own two legs that are in the marketplace as a replacement. A replacement is not a good thing. During the war, people drank chicorée, which is replacement for coffee. It doesn't taste good. I think people need strategies that can stand on their own two legs, regardless of the fact that fixed income is no longer appealing as a diversifier to equities.
Well, you've talked about some of the factors you're trying to expose to there. How do you combine those in a portfolio? How does it work?
First, you need to identify these factors. You need to identify them through three criteria that are very important. Are they statistically significant? Meaning, are they persistent over very long periods of time? Then, are they plausible? What is driving them? What are the human behavioral biases that we all share that ensure that these will continue in the future? So, statistical plausibility and behavioral biases, or real economic or financial theories such as risk transference, right? To assemble them properly, you need to understand what their correlation characteristics are to one another in order to assemble things that are a priori and on a realized basis not correlated to one another. Here I want to be very careful when I use the word correlation. Many people assume that means when the stock market crashes, this will not be correlated. No, that's actually anti-correlated. And we're not in the business of providing products that are anti-correlated, but uncorrelated over the long term. What that means is that I don't know what the correlation of this approach will be in the next crash. That's an honest statement. I know that over the next 10 crashes, the correlation on average will be 0. That's what's important. So understanding the correlations, and then understanding what we call the skew profile. Skew profile is not very complicated. We all like beta, right? The growth factor. We like it because it's persistent and it has a Sharpe ratio of 0.4. There's one thing we don't like about the growth factor, is what we call crashes. That's a negatively skewed strategy. That means that when you look at the P&L of the growth factor, the big days tend to have a negative sign to them rather than a positive sign. Meaning the market crashes down, it doesn't crash up. So there's an asymmetry that's negative. And that's what we don't like about the growth factor. There are other factors that have positive skew. So things like long-term trend following on a multi-asset class basis tends to crash up, not crash down. Investing in value tends to crash up, not crash down. Momentum is slightly negatively skewed, but the moments of the skewness are not correlated with the market, so it's not so important. The other strategies I mentioned, the risk premias and the quality factor, are negatively skewed. But the market is quite negatively skewed itself. So what we're trying to do is perhaps try and take that skew in a little bit, to not have that much correlation over time to the fact that the market crashes, right? But I want to be clear, Mark, this is not anti-correlated. It is decorrelated, which is not the same thing.
So why is CFM the organization to do it?
A lot of these things that I'm talking about have been known, archived, written about in academia now for well over 20 years, some of them. You have practitioners in this space now for 2 decades plus. While the concepts are well understood, like many things, the proof is in the pudding and in managing the details. In order to manage the details, some of the things that you need to do is to run your portfolio on what we call a constant risk basis, which means you need to have technology to sample the risk in your portfolio, and the risks are all different depending on the factors. And if the risk regimes that we're in are shifting, you have to be able to sample that shift, isolate it, and reshape your portfolio to bring it back into the boundaries of the risk that you find tolerable. If you cannot do this, you'll be submitted to variable risk delivered by the factor. And the portfolio effect that you were trying to seek won't be coherent. You won't have a desirable outcome if you can't control the risk. The other thing that's absolutely key, when working with data, human beings have a tendency to over-parameterize and be overconfident in what type of Sharpe ratios they can achieve in any one single factor. Reducing that risk, that we call in-sample bias risk, is something that you only learn through sheer experience. There's techniques that you can use, but ultimately you have to have a very high degree of savoir-faire in order to be able to recognize the moments when there's a certain lack of intellectual honesty in the process, whereby things have been complexified in order to get better outcomes, and you need to resimplify things. And then you have to be modest in terms of the future when you already know it, since you're working with the data, and recognize that the real future is made up of unknown unknowns, things that we cannot factor in today because they're variables that have never been observed. So you need to discount the Sharpes that you anticipate by at least 30% of unknown unknowns, in order to deal with the fact that you already know the future when you're working with the data, right? So you have to be very humble and apply some discounts as to the things that you truly don't know. So life can only be understood when looking at it backwards, but it has to be lived going forwards.
And finally, Philippe, how do Australians get access?
Well, we've invested quite a bit in this country. We have created an onshore feeder fund, and we are launching, we're in the process of launching now. It's denominated in Australian dollars. So we've built something for Australia, in Australia, for Australians, in this product that we call ISD.
Well, Philippe, sounds like a really interesting solution to the problem. Thanks for joining us.
Thanks for having me, Mark. Goodbye.
And thank you for joining us here on FSI TV. We'll see you next time.